So this is chapter 11, current liabilities. As we all know that current liabilities means debt. Current in here means short term. Short term in accounting usually means less than 1 year. Okay. So current liabilities is the short-term debt that you have, and you have to pay it within 1 year. Okay. So liabilities, you get the liabilities because of the past events. For example, you buy supplies on credit from your supplier, so you got payable, and then these supplies later you will use for future sacrifices. Okay. So this is the classification of liabilities. We have current liabilities, which is our focus for today, and long-term liabilities. We will not learn long-term liabilities in fundamentals of accounting. Long-term liabilities we will learn in in elementary accounting too. Okay, but in this semester we only stop until here. So current liabilities expected to be paid within 1 year of the company's operating cycle. Okay, like I mentioned before. This is just example of current liabilities from some companies. Nestle, Leaning, Adidas, Puma. Okay. Current liabilities is a percentage of total liabilities. So as you see here, Nestle for 58.5%, Adidas this percent. So how do they get this number? They just want to know how many percent the current liabilities from the total liabilities. Okay, so current liabilities equals to total liabilities. We have some uncertainties in liabilities. We have uncertainty in whom to pay, okay, to whom we pay, okay, and then uncertainty in when to pay. So we have to know the date, okay, and then uncertainty in how much to pay. We have to know how much or the amount of our debt, and this one to whom, this one how much, this one how much, this one the date. Okay, this is the uncertainties. So if you want to have a certain information about liabilities, then these three things have to be fulfilled. Okay, there are some noun liabilities actually in this slide. Okay, accounts payable, sales tax payable, unearned revenue, short-term notes payable, and payroll liabilities. Okay, this is sales tax payable. So sales tax are called goods and service tax in some countries. In some countries, they call it as GST. Or some other countries, they call it as value added tax. It's the same thing. On August 31st, Harvey Norman sold materials for $6,000 that are subject to 10% GST. Okay, so Harvey Norman makes sales for 6,000, and then from this 6,000, they have the tax payable for 10%. So how Harvey Norman needs to record. So Harvey Norman records sales 6,000 and then payable 600, and then receive 6,600. So usually when you buy something in the shop, right, you already pay the VAT. I mean, the VAT already included in the price. So actually the VAT in the practice, VAT is paid by the customer to the seller, but seller will buy it, will pay the tax to the government. Okay. Unearned revenue. On June 30, Beyonce sells 5 million in tickets for 8 concerts. So, and in this example, Beyonce just sells this ticket on June 30, but Beyonce still not perform the concert, right? Still not doing the, Beyonce is still not doing the obligation. So Beyonce will record cash 5 million and unearned ticket revenue 5 million. So unearned ticket revenue or unearned revenue is liabilities, yeah, or debt. And then on October 31st, 4 months, the next 4 months, Beyonce performs a concert, just one concert. Okay, so meaning that Beyonce just has just done the obligation to perform one concert. So when Beyonce done the job, then Beyonce can claim a revenue 625,000, and then the liabilities is deducted for 625,000. How do you get this number? This one, 5 million is for 8 concerts. So you have to know, you can calculate how much is for one concert. So 5 million divided by 8, so you got $625,000 per concert. Okay. This one, short-term notes payable. A written promise to pay a specified amount on a definite future date within 1 year or the company's operating cycle. So we have accounts payable, right? And then short-term notes payable. So in the accounts payable, there is no paper. There is no definite deadline. No. Okay. But in the short-term notes payable, they have the note. Note means the paper. So in this paper, we can know the deadline of the debt, and then to whom we pay, and then also the amount, okay, on the paper. But for account payable, we do not have the paper. Okay. And usually the short term the notes payable have interest usually. Okay, let's see. On August 23rd, Brady Company asked McGraw to accept 100 cash and a 60-day 12% 500 note to replace its existing 600 accounts payable. Okay, in this case, Brady asked McGraw to convert account payable to be note payable. Okay, and as you can see here, Brady Company asked McGraw to accept 100 cash and this note to replace its existing 600 accounts payable. Okay, so Brady Company actually has debt to McGraw for 600 accounts payable, $600. But on the deadline, McGraw cannot pay this account payable. So, sorry, Brady cannot pay this account payable. So Brady said to McGraw, I'm sorry, at this date, I do not have any money to pay $600 account payable. How, I just only have $100. How if I give you $100 and then convert the accounts payable to be note payable? Okay, what is so McGraw might be interested in it because once McGraw have the notes payable, then McGraw can earn more money from the interest. Okay, if McGraw just say like okay, I will just extend the deadline, or okay, I just received $100 and then another 500 you can pay later, McGraw will get no benefit or no revenue from extending the deadline. So that's why Brady offers Migros to extend the deadline by converting accounts payable to be note payable. So that's why when Brady give the cash to Migros, so Brady will record cash on credit, and then the accounts payable of the Migros the accounts payable will be decreased 600, and then the notes payable will increase. Okay. And then on October 22nd, Brady pays the note plus interest to Migros. Okay. And then on this date, Brady pay. So notes payable decrease 500, interest expense $10, and then cash 510. How this $10 come from? Remember from the previous slide that we have 12%. Remember when you find an interest rate like this 12%, 12% is always for a year. But the notes payable is only for 60 days. So that's why when you calculate the interest rate, you have to calculate by this one 12%, multiply by 60 divided by 360, and multiply with 500. Then you get $10. So Migros will receive $510. This is the example of the note. They have the money, the amount, the date, and then the percentage. Okay. This is the date of the note, and this is the deadline after 60 days, something like that. Okay. On September 30, a company borrows $2,000 from a bank at 12% interest for 60 days. So the company will record cash $2,000 and notes payable $2,000. Okay, one company goes to a bank and wants to borrow $2,000, and then the company will give notes payable to the bank. So that's why the company will record cash $2,000 because the company received $2,000 from the bank, and note payable $2,000. The company give a note to the bank, this note. Okay. And then on November 29, the company paid the principal of the note plus the interest. So notes payable $2,000, and then interest expense $40. This is how you calculate that. And then on the credit side, you record cash $2,040. Okay. Same case like before, I guess. And then sometimes you need to make an adjustment at the end of the period if the maturity date is not beyond the accounting cycle. Okay, beyond the end of the period. That's an example. On December 16, 2011, a company borrows $2,000 from a bank at 12% interest for 60 days. Okay. An adjusting entry is needed on December 31st. Of course, when you borrow the money at this date, you have to record, yeah, but we will not cover in this slide. And then you need to make an adjusting entry at the end of December. Why? Because from December 16 until 60 days from December 16 already will pass the end of the accounting year, accounting cycle, accounting period. Okay. um, but you have, because of that, you have to make the adjusting entry at the end of the year. So how you make the adjusting entry? You will record interest expense and interest payable, right? And then the number is, the amount is $10. How you get the $10? So remember that you have a payable of 2000, and then 12%, and then from 16 to 31, it's 15 days. So 15 multiplied by 360, and then you got this number. Okay. And then next, on February 14, which is the deadline, for February 14, 2012, the company pays the principal and interest on the note. Okay. Company will record cash to 2040, right? 2040. And then the interest payable, $10. Last time the company has the interest payable for $10, but at this date the company pay the payable, so the company will record $10. And then interest expense 30. Okay. They recorded actually last year for $10, so at this date the company will record another $30. Okay. And then notes payable 2000. Notes payable 2000. So company pay $2,040 on the deadline.